Welcome to The Explainer. Today we're digging into a fascinating new report that sketches out a pretty dramatic shakeup for the AI world, all centered around 2026. And it all comes down to something the report calls the efficiency shock.
So, let's get right into it. The big question on everyone's mind for the next couple of years, right? Is this whole AI boom a real, sustainable revolution, or is the market just running on hype, heading straight for a massive correction? Well, this new analysis we're looking at makes a really compelling case that 2026 is the year we're going to see a huge reevaluation.
And at the core of this whole thing is a massive, almost unbelievable difference in cost. You know the model we're all used to? Big tech pouring billions of dollars into GPUs just to train a single AI. But what if? What if a company could get a top-of-the-line model for less than $6 million? I mean, that's not just a little bit better, that's a game changer. It's a kind of disruption that could totally rewrite the economic rules for AI.
So, that brings us to our first section, the efficiency shock. What's the catalyst for this whole potential disruption? Well, the report points to one specific event it's calling the efficiency shock. Basically, a huge breakthrough in training AI super cheaply and effectively. And the company at the center of it all? A name you'll want to remember, DeepSeek.
Now, to really get a handle on how the market got here, the report brings up this really interesting German idea called Schwarmdumm. It literally translates to herd stupidity. It's this concept where you can have a bunch of incredibly smart people, right? But as a group, they can end up making some really bad decisions, all because they're following one simple, flawed idea. And in the AI world, that one big idea has been
that the only way to get better AI is to just throw more and more expensive hardware at the problem. I mean, that single belief is what fueled the insane valuations for chip companies. But if this new, super efficient model really works, well, it doesn't just question that belief, it completely shatters it. And that puts the entire foundation of those massive valuations at risk.
Which leads us right into our second section, what happens when the hardware bubble bursts. The report calls it hardware's great reevaluation. So, if that core assumption about more hardware equals better AI is proven wrong, what's the fallout? The prediction is a fast-moving chain reaction that's going to be felt everywhere.
And this is a fantastic breakdown of that chain reaction. The report calls it the contagion channel. So step one, you get proof that a hyper-efficient model is possible. That's the trigger. Then comes step two, the spending pause. All of a sudden, big tech slams the brakes on those massive GPU orders. What happens next? A sharp correction in chip stocks, think NVIDIA and others, as all that future revenue just evaporates. But it doesn't end there. That shockwave ripples all the way down the supply chain, hitting memory makers in places like South Korea really hard.
Okay, so now things get even bigger. Section 3, a broadening global storm. This is where it gets really interesting, because the report argues that this tech crisis doesn't happen in a neat little bubble. Nope, it's on a collision course with some other huge global pressures that are already swirling out there, potentially creating a perfect storm. So there are three of these supercycles. The first one is the AI tech shift itself, right? This move from a hardware-first to a software and efficiency-first model. That's the main shock we've been talking about.
Then you've got the second supercycle, the geopolitical one. We're talking rising global tensions, trade breaking down. It just adds this whole layer of uncertainty over everything.
And then there's the third one, the fiat currency cycle. With massive government debt piling up, there's a ton of pressure on central banks. And that's starting to chip away at the trust people have in regular currencies, which of course makes them look for other places to put their money. Okay, so you've got these three huge forces all colliding. The big question is, what does that actually look like for the markets in 2026? Well, that's exactly what Section 4 is all about. The report breaks it down region by region, and this is where the rubber meets the road. Let's start with the US. The outlook here is for some serious volatility, especially in the NASDAQ, as that hardware bubble starts to deflate. In the bond market, they're flagging something called a bear steepening, which could see long-term rates rise. And at the same time, all that uncertainty we talked about, the geopolitical and monetary stuff, could just keep pouring fuel on the fire for hard assets like gold. The report even notes a JP Morgan target of $8,000 an ounce. Wow.
Now, what about Europe and the UK? Well, the picture there is a bit more stagnant. The report sees growth being held back by things like energy prices and all those geopolitical risks. But the really critical point here is for their tech sector. Think about key suppliers like ASML. They could be facing some serious trouble as the market shifts away from their super high-end gear.
And this is really fascinating. In Asia, the report projects a huge split. On one side, you have countries like South Korea, which are super dependent on hardware. They could be looking at a full-blown chip cycle crisis as demand for things like high-end memory just falls off a cliff. But then, on the other side of the coin, you have China. This exact same shift could actually be a huge boost for their tech companies, since they're already all in on software and efficiency.
But the analysis doesn't stop there. It asks a really important what-if question. What if this efficiency leap is even bigger than we think? What if, say, in February 2026, a new breakthrough is announced that's just absolutely massive? The report actually models this out as a potential black swan event.
And this is what that scenario could look like. It's being called the February shock. If a new, radically more efficient AI model drops early in 2026, the models are projecting a really severe, really fast correction. Look at these numbers. The semiconductor index could drop 30 to 40%, the NASDAQ 100 down over 20%, and Korean tech stocks could see a 25 to 30% hit. That is a serious system-wide shock.
So this leads us to the final and maybe most important section, the new investment paradigm. And this is the key takeaway. The report isn't just predicting a market dip, it's arguing we're on the verge of a fundamental change in what the market even cares about, a total paradigm shift.
So where does the money go? The report is pretty clear on this. It sees a huge rotation of capital. It's going to flow away from the companies that just make the hardware and to the companies that actually use AI efficiently. So we're talking about fields like robotics, healthcare, logistics. It also flows to the stuff that supports all this, like data centers and energy. And finally, with all the uncertainty, it continues to flow into hard assets like gold and Bitcoin as a hedge.
And that leaves us with this final, really powerful idea from the report. It completely changes the question investors need to be asking. For the past few years, the question has been, who's buying the most expensive chips? But in 2026, the report argues, the real question is going to be, who produces intelligence most efficiently? It's a total shift from just brute force to actual, elegant efficiency. A really provocative thought to end on.